Max Planck said, science advances one funeral at a time. And what he meant was the old guard, they will never ever accept a new idea. Whatever it is, they'll die. They will not accept a new idea. The only way you get people to accept a new idea is you wait for a new generation of decision makers.
Michael Saylor positions Bitcoin as the next evolutionary milestone in the history of money, arguing that its long-term trajectory is essentially unstoppable. In his view, Bitcoin represents a superior store of wealth in today's world, one defined by persistent inflation and aggressive monetary expansion. At the heart of Saylor's thesis lies a simple but transformative idea: digital scarcity is becoming the new foundation of value. Just as gold once revolutionized finance through its physical scarcity and universal acceptance, Bitcoin is now doing the same in the digital era. Unlike traditional assets, Bitcoin's decentralization, verifiability, and immunity to government control make it a form of pure, incorruptible money, a digital parallel to gold that transcends borders and political systems. Saylor believes this shift marks the beginning of a monetary renaissance, where value is no longer bound by geography or central authority.
And the old guard retires and they age out. Or you need a war, and people that don't believe in aircraft, but to start believing in aircraft when the aircraft flies over their city and drops a bomb on their head. And people that don't believe in atomic energy start believing in atomic energy if someone sets off a nuclear warhead in the middle of a war. And so I think that disruptive, profound events like a near-death experience like during COVID, I think that introduces new ideas and new paradigms. That's how we got introduced into this space. It was the war on currency and the war on COVID in 2020 that caused us to open our eyes and embrace the new idea. I would say 95% of the decision makers in the finance world still don't really embrace or understand the idea of digital energy, digital capital, digital money. And I don't think it's a bad thing, because the only way you're going to make 10 to 100x your money is if you pick the right thing and everybody disagrees with you.
Yeah.
If everybody agrees with you and you do the right thing, well, everybody agreed you should buy Amazon in the year 2020 during the lockdowns because it was quite obvious that you needed Amazon during the lockdowns. It's the worst investment of the past 5 years because everybody agreed that it was a good investment, and there's a lesson in that.
Mm-hmm.
Bitcoin, right? One could argue that Bitcoin was born out of skepticism, right?
Mm-hmm.
And so it's deep in the ethos and the culture, the idea to question everything, slay your heroes, don't trust, verify.
No.
Right. So the whole idea of Bitcoin is, don't trust anybody, don't trust any institution. And so if you start asking the question, how do you create an economic protocol where you don't want to trust any of 8 billion people and any of 400 million companies and any government? That's an interesting question. I would say that skepticism has its place. It is motivational. But at some point, it can become, what is the word?
Counterproductive, maybe?
Counterproductive idealism, right? And the truth of the matter is, you do need to trust a company to create the airplane you fly in. You do need to trust the company that creates the car you drive in. You do need to trust the dentist at some point because you can't. And you do need to trust the doctor because you can't take your own appendix out, or at least it's very rare, right? And so at some point, you do have to trust something. And I would say, the more evolved way to look at Bitcoin is not that you want to embrace it and never trust anything. The real inspiration and the promise of Bitcoin is once you've embraced it, you have the option to extend and withdraw your trust, from time to time. And if you choose to not trust the government, you can relocate your Bitcoin to a different country. And if you choose to trust a custodian, you can locate your Bitcoin with them. And when you decide to stop trusting them, you can relocate your Bitcoin to any of 100,000 other entities. Or if you go through a period of life when you choose not to trust anyone, you can self-custody. And when you decide you don't trust yourself, you can transfer your custody to another family member, right? And change. So the real power of Bitcoin is optionality. And the reason we have the optionality is because the entire movement was born out of distrust. Mm-hmm. Yeah. And so there is a yin and the yang. There is a dialectic here. And you need a healthy degree of skepticism and distrust and cynicism. But once you've created the technology, you're not going to reach your full potential unless you work with other human beings, right? And so
Bitcoin began October on a turbulent note, facing one of its sharpest short-term corrections of the year. Despite its strong long-term outlook, the cryptocurrency's rally above a new all-time high of $126,000 was quickly followed by a steep decline, erasing nearly $23,000 in just 10 days. The sudden sell-off was fueled by rising geopolitical tensions, particularly renewed tariff threats against China from former U.S. President Donald Trump, which sent shockwaves through global financial markets. This external pressure combined with massive liquidations in an over-leveraged futures market, intensifying the downward momentum and briefly driving Bitcoin below $114,000, with some exchanges even recording flash crashes as low as $101,000. Investor sentiment was further rattled by strong earnings reports from U.S. regional banks, which paradoxically heightened fears of a broader banking crisis. As a result, institutional investors turned defensive, leading to over $1.2 billion in weekly outflows from Bitcoin ETFs, while gold prices surged past $4,400 per ounce as traders sought traditional safe haven assets. Despite this correction, analysts note that Bitcoin's fundamental structure remains solid, viewing the drop as a healthy market reset rather than a signal of long-term weakness.
Ultimately, when you decide that you're going to work with other human beings, either as a trusted custodian or a trusted hardware device manufacturer or a trusted hardware wallet, or you work with another corporation, it's a trusted team of people, whether they, work on your teeth or work on your heart or manufacture the food or provide you with the aircraft, travel you need. At that point, you can reach your full potential, and you do it empowered, with property rights and with economic rights. And the reason that you will be able to trust them is because you have the option to withdraw your trust. Mm-hmm. All right. So I look at it as the great deterrent. If you think about gold and why gold failed, one reason gold failed is it's so incredibly difficult to custody. And so if you look at in the history of gold, in the 20s, you had four great central bankers, and the central banker in Germany was Schacht, and the central banker in the U.S. was Ben Strong. And the world, was substantially on a gold standard, and the Germans had gold. And the French had gold, and the British had gold, the Americans had gold. But for the most part, the gold was either in London or in New York. The French gold was with the British or the Americans, or the German gold was with the Americans. So there's a famous story where Schacht traveled to New York City, met with the head of the Fed, Ben Strong, and Ben Strong wanted to show him the German gold, took him down into the basement of the New York Fed, and they couldn't find the gold. And of course, the message of the story is this: gold is so difficult to custody, countries couldn't figure out how to, like the entire country of Germany couldn't figure out how to custody their own gold, much less the 100,000 companies in Germany or the 60 million people in Germany. And so the reason gold failed was it was too slow and too difficult to custody, and therefore your property rights were always going to be impaired by a central actor. And, imagine the entire world running on gold-based credit on a gold standard when all the gold in the world was sitting in London and New York City, and most of it was in New York City, and we can say, oh yeah, that's a bearer asset, but not really, because 40 million companies couldn't bear it. 400 million people couldn't bear it, right? And so Bitcoin, it represents the bearer instrument, but it really is practical for an individual to take custody, and it's practical for a company to take custody. And of course, I guess what I counsel to people that are idealists is they don't trust banks and they don't trust companies. But the point that I would make is, during the entire gold era, gold was so difficult to handle that no company could custody their gold, and no bank could. If we lived in a world where 40,000 banks were custodians of Bitcoin, you would have evolved from a world where there were like 8 or 6